Imagine this. You found the perfect apartment, it's in the right neighborhood, it's got great light, and you can actually afford the rent. You fill out the application, you're excited, and then 3 days later, you get the email. Denied. Why? Because of a three-digit number that somehow defines your financial trustworthiness to a total stranger. Or maybe you go to buy a car. You see the sticker price and think, okay, I can manage those monthly payments. But when you sit down with the finance manager, that monthly payment suddenly jumps up by $150. Why? That same three-digit number. If you live in the United States, there is perhaps no single number that has a bigger impact on your daily life and your future wealth than your credit score. Yet they don't teach this in high school. Most of us learn about it the hard way, when we get rejected for something we need. Today, we are going to fix that. We're breaking down exactly what a credit score is, the secret ingredients that make up that number, and why ignoring it is probably costing you thousands of dollars. Let's dive in.
Welcome to Credit and Cash, where smart credit meets real money.
So what is a credit score, really? At its simplest level, think of it as an adult financial report card. But instead of grading you on algebra or history, it's grading you on how well you handle borrowed money. It is a numerical prediction of risk. When a bank, a landlord, or a car dealership looks at your score, they are asking one question. If I lend this person money, what are the odds they will pay me back on time? A high score tells them, don't worry, they're good for it. A low score tells them, gambling on this person is risky. In the US, these scores generally range from 300 on the low end, very risky, to 850 on the high end, perfect. Now you might hear about different brands of scores. The big one is FICO. That's the one most lenders use. There's another one called Vantage Score, which you see a lot on free credit apps. Don't get too hung up on the difference right now. They both measure the same behaviors. If your score is above 740, you're generally considered excellent and you get the VIP treatment. If you're below about 580, things get difficult and expensive. But where does this number come from? It doesn't just appear out of thin air. It's calculated using data from your credit reports. Think of the credit report as the messy pile of homework and tests you did all semester. The credit score is the final letter grade the teacher calculates based on that pile of work. So what is the teacher looking for when grading your homework? There are 5 main ingredients. This is the most important part of the video. If you understand these 5 factors, you know the rules of the game. We're going to use the FICO model percentages here, as it's the industry standard. Ingredient number 1, payment history. This is 35% of your score. This is the big one. It's very simple. Do you pay your bills on time? Lenders want to see a long history of paid as agreed. A single payment that is 30 days late can tank your score by a significant amount, sometimes 50 to 100 points instantly. It's the equivalent of failing the midterm exam. The golden rule of credit. Never be more than 29 days late. Ingredient number 2, credit utilization. This is 30%. This one confuses people, but it's crucial. This is basically, how much of your available credit are you currently using? Let's say you have one credit card with a $1,000 limit. If your balance is $100, your utilization is 10%. That looks great. You're responsible. If your balance is $950, your utilization is 95%. To a lender, this looks like you are maxed out and possibly in financial trouble, even if you make the payments on time. A good rule of thumb is to keep your utilization below 30%. But if you really want an excellent score, aim to keep it under 10%. Ingredient number 3, length of credit history, 15%. How long have you been in the game? Lenders like to see a long track record. This considers the age of your oldest account and the average age of all your accounts. This is why you should think twice before closing that old credit card you got 10 years ago that has no annual fee. Even if you don't use it, just keeping it open is helping the average age of your credit history. Ingredient number 4, credit mix, 10%. Lenders like to see that you can handle different types of debt. There's revolving credit, like credit cards where the balance goes up and down, and installment loans, like a car loan or student loan, where you pay a fixed amount over time. Having both is slightly better than just having one type, but don't go open a loan just for this. it's a small factor. And ingredient number 5, new credit, 10%. Are you desperate for money right now? Every time you apply for credit, a loan, a new card, the lender does a hard inquiry on your report. 1 or 2 is fine. But if you apply for 5 credit cards in one weekend, you look risky and your score will drop. Okay, you might be thinking, I don't plan on borrowing money anytime soon, so who cares? You should care. Because in the US, your credit score affects way more than just getting a loan. It's intertwined with your cost of living. Let's look at the biggest purchase most people make, a house. Let's say 2 people buy the exact same $300,000 house. Person A has a great score of 760. They might get a 6.5% interest rate. Their monthly payment, principal and interest, is about $1,896. Person B has a mess score of 620. Lenders see them as riskier, so they charge a higher rate, maybe 8.1%. Their monthly payment is $2,223. That's a difference of $327 a month for the exact same house. Over the life of that 30-year loan, person B with the lower score pays nearly $118,000 more in interest. That's a retirement fund right there, lost to a bad credit score. It's not just houses. In many states, car insurance companies use a version of your credit score to set your premiums. Bad credit can double your insurance cost. Landlords check it before renting to you. Cell phone providers check it before giving you the newest iPhone on a payment plan. Some employers even check a version of your credit report before hiring you for jobs in finance or management. They see financial irresponsibility as a character risk. Your credit score is basically the difficulty setting for your financial life. A high score is easy mode. A low score is hard mode. My goal with this channel is that you never have to play life on hard mode again. If you're sitting there thinking, I have no idea what my score is, here are your first 2 steps for this week. Step 1, check your score. You don't need to pay for this. Many banking apps, like Chase, Bank of America, or Capital One, provide a free Vantage score or FICO score right in their dashboard. You can also use services like Credit Karma. Just knowing where you stand today is victory number 1. Step 2, remember that 35% payment history factor? Bulletproof it. Go to every single bill you have, credit card, utility, phone, and set up automatic minimum payments. You should always try to pay more than the minimum, but setting up the automatic minimum ensures you never accidentally miss a payment and tank your score. This is just the beginning. Credit is a tool. It can build wealth or it can destroy it. Here at Credit and Cash, we're going to learn how to master that tool. If you found this helpful, please hit that like button. It really helps us, and subscribe so you don't miss our next video on building credit from scratch. Thanks for watching Credit and Cash. I'll see you next time.